The Australian Financial Review.
Hello, I'm James Thomson, Chanticleer columnist at the Australian Financial Review.
And I'm Tony Boyd, Senior Chanticleer columnist at the Australian Financial Review.
Welcome to the first episode of Chanticleer, our weekly news breakdown of all things business, finance and markets. Today on the podcast, we'll take a look at the deepening scandal surrounding casino operator The Star. We'll ask why US inflation spooked markets right around the world, and we'll look forward to the Federal Reserve's big rate call. But Tony, this is our first episode, and before we begin, perhaps we need to share with our audience a little bit about who or what is a Chanticleer, and as the elder statesman of the column, can you give us a little bit of the origin story?
Well, the Chanticleer name comes from a story written by 14th century writer Geoffrey Chaucer. It's about the rooster who was lured out of the barnyard by a wily fox, who grabs him by the neck and runs. Now, the rooster convinces the fox to open his mouth. The rooster escapes. And really, the moral of the story is just be very sceptical about people coming to you with glowing promises, especially maybe PR people, spruikers, bankers and others wanting publicity.
Yes, it's a good lesson, and I think the sceptical chickens is just about sums us up perfectly, Tony. So we should jump into the first topic, which we've both written on this week, and I think has captured corporate Australia's imagination, and that's the Star Entertainment Group. For those who haven't been following this, the scandals at the Star Entertainment Group follow, of course, from a big range of scandals at Crown Resorts, which runs casinos in Melbourne, Perth and Sydney. The problems at the Star were remarkably similar. They had sort of done a deal with the devil in the form of these junket operators who are backed by Asian criminal gangs, and that went horribly wrong for them. There was alleged money laundering through those junket operators. There's issues with credit card transactions for gambling money being disguised as hotel expenses. And there's sort of a broad range of governance and accountability failures and culture failures across the board. Tony, this is really a bit of a stinker. I mean, is it possible to run a casino operation in this country without, getting down into getting down into the dirty part of the business?
It's a very good question, James. I think now that we've had the Bell inquiry into Star, the Finkelstein inquiry and the Bergen inquiry into Crown, the WA Royal Commission into Crown, and we've also got Queensland's Goddison inquiry, I think we can conclude that these companies really did not understand their legal obligations, either to regulators or to, in fact, their own ethical obligations as company directors and managers. Extraordinary how the Star used this term legal professional privilege to basically hide any document from whoever they wanted.
Yeah, the report goes deep into what management did and didn't know, or should and shouldn't have known, and also what the board should and should have known. And I think it makes a really good point around the setting of culture. The board had a view on the culture that they wanted to set at Star, but they weren't really aware of the actual culture that was sort of pervading up from the management team and pervading the shop floor, as it were. So, this is a tough thing for a board to get their heads around. You have 10 or 12 or however meetings a year. How are you supposed to keep tabs on this? But in a highly regulated industry like casinos, where everything can go wrong, you really need to be right on top of this stuff, surely.
Yes, and when your rival is effectively the canary in the coal mine and you don't do anything about this junket operator, Sun City, when they've already been pinged for it, it's just defies rational thinking, doesn't it? That the board of Star never really thought that they should look deep into what their own company was doing. But, what about the professional investors? I mean, the share price went up on the day the Bell inquiry report slobbed, I think the 3-volume inquiry. What did you make of that?
Well, look, we saw this at Crown too. I think it probably says a couple of things. A, the bad news was probably priced in. Investors and the market thought a big whack's coming for the company here, and perhaps they thought it's not as bad as it could have been. They didn't lose their license. The casino's not shut. So it's a bit of good news in a way that the nuclear option hasn't been triggered. And I think probably it says that some investors, as has happened at Crown, are probably thinking there'll be someone who wants to buy the Star. There'll be someone who can come in and say, we're the clean slate. We can start again and reform this place. And perhaps there's a bit of takeover tension in the share price too.
Yeah, I think you're right, especially when you think it's trading on about 28 times forward PE and the analyst target prices are 20% higher than where the stock is at the moment.
Yeah. Tony, one of the issues that you raised this week was around money laundering. And obviously casinos are ripe for risk around money laundering. And the Bell inquiry makes clear that there was this could have well happened, or at least the Star exposed itself to those risks. What's your sense here? Will anyone ever get done in this country for money laundering, or is it just a sort of big idea that never quite gets nailed?
Yeah, it is a great mystery to me, and also, as you may have noticed, our editorial writers, we had a very strong editorial saying, is anybody going to be charged or sanctioned for what's been going on at these two casinos? And at this point, it seems like nothing is. And yet there's enormous resources pumped into trying to stop money laundering, which is really, I think one of the estimates I saw in the Finkelstein report was $10 billion a year is happening in Australia. That's pretty extraordinary. But will anything happen? Perhaps the public pressure will lead to governments who are addicted to gambling revenue to finally take this seriously after what's transpired.
Yeah. Tony, we should jump on to the second big topic of the week, which is a pretty wild week on markets. I mean, at the start of the week, we sort of had the stirrings of a rally around the world. Wall Street was rising nicely. The ASX rose for 4 straight days. We were starting to sort of turn that frown upside down. And then on Tuesday night, Wednesday morning here, we got the US inflation number. This was a real shocker to the world, wasn't it?
Definitely, and ever since that happened, I think analysts and economists are starting to question the terminal rate that the Fed will actually get to. Probably the neutral rate in a normal times will be between 2% and 3%. But I even have seen some outlandish, maybe they're not outlandish, that the terminal rate might now in America be between 5% and 6%. And that is a huge shock. They really do seem to want to get a recession in America to kill inflation.
Yeah. I mean, the inflation numbers themselves are really interesting. So people had expected headline inflation, which includes gasoline and food inflation. Everyone had expected that to fall a little. Actually, it went up a little month on month. And then core inflation, which strips out gasoline and food, everybody expected that to go up 0.3% month on month. It actually went up 0.6% month on month. So what that says to us is despite all these rate rises, the Fed hasn't actually got inflation moving in the direction it wants. Inflation is still rising. So that's just been a reminder to the market that the Fed's got a lot more work to do. And perhaps central banks around the world have got a lot more work to do in bringing inflation down. That's obviously caused a bad day on markets on Tuesday night and Wednesday. Wall Street was off between 4% and 5%. The Australian market was off about 2.5%. There's been some interesting knock-on effects though, Tony, and one of those is on deals. So we've had some big M&A battles, I guess, come to a head this week. We've seen KKR, which was bidding for a big private hospital operator, Ramsay. They've abandoned that deal. And then we've seen a big super investor called IFM Investors getting very shirty with a toll road operator called Atlas Arteria. What's behind this sudden rise in corporate biffo?
Well, part of it is explained, I think, in the Ramsay case by just deteriorating conditions for that private hospital operator. By the way, the tensions between KKR and Ramsay really did bubble over in the background. They weren't necessarily, KKR was saying we're still friendly, we might come back. But when you scratch below the surface, the board of Ramsay is very angry at being blindsided twice now by KKR with announcements that forced them to cause a suspension of trading. So, but yeah, the deterioration in their earnings is the reason that one's died. IFM really is at loggerheads with Atlas just about its expansion plans, and they've gone ahead with them anyway. And I suppose you've got to feel some sympathy for them. While they're fighting the company, it's issuing equity, and they really have to buy that to not be diluted. The other one, of course, is Link Administration. This company's been in and out of takeovers for 3 years now.
Yes.
And finally, the FCA in London has said you need to put aside about $500 million to cover potential fines for the lax supervision of what was called the Woodford managed funds in the UK. So that one really hangs on a very sweet financing deal from Ares Capital to Dye and Durham in Canada, which ends on September 30. And I don't think that sweet deal will be available after that day. So that one could well die as well.
Clock's ticking. I mean, the other thing to say here, Tony, is during sort of periods of market dislocation, when markets are falling, it does become very hard for two companies to agree, a takeover, a buyer and a target to agree on what the right valuation is. The buyer's always going to say, well, look, I'd like a bargain at these new reduced share prices. And the target's always going to say, no, this is just a temporary blip. We'll be back to our previous highs before you know it, and you better pay up for the company. So there's always a valuation gap between a buyer and a target. But in these periods of, volatile markets, those valuation gaps get a lot harder to close. Tony, what we've seen this morning, the RBA governor is been appearing before the Senate. He seems to be suggesting that the pace of rate rises here will slow down a bit. Are you taking this as a good signal that our fight against inflation might be coming to maybe not coming to an end, but starting to gain traction?
Yes, I do. I mean, that fits with the view that I've expressed in the column that the rate peak in Australia is coming sooner than expected. But it's fascinating to watch what's happening in the share market. You may have seen 3 big yield plays in property. Dexus, Shopping Centres of Australia and Stockland all hit 12-month lows this morning. So Governor Lowe's comments didn't really help those lows. I mean, what's happening is, of course, is the yield plays are really being hammered because rates are going to keep going up, even if we take some satisfaction that the peak of that is going to happen sooner rather than later.
Yeah, I worry a bit, Tony. I'm not so sure I agree with you. I worry a bit that what's happened in the US this week might end up playing out a bit here, that inflation might actually be a bit stickier than Philip Lowe and a lot of economists think. In areas like rents, where once they start rising, it's very hard to get them to cool down again. I think we might find, as the Fed is finding, that the economy is still pretty strong, the jobs market's pretty hot, consumers are still pretty cashed up, and it might take a bit longer and higher rates to burst that bubble. But look, we're going to come back after the break and have a look at some of the big events for next week are, and let's just say that this narrative of where rates go from here is going to be dominant again. Well, Tony, one of the big pressure points for inflation and interest rates is, of course, the property sector. The Financial Review's got its annual property summit on Monday. And this should be a really good source of debate around house prices particularly. Where do you think house prices are going? I mean, we've seen predictions of falls from anywhere from sort of 10 to 15 to 25%. What's your view?
Well, look, I'm more of a optimist about this, James. I look at how much house prices have risen and compare it to how much they've fallen. And I don't even think we're back to early 2021 yet. So I think the house price falls will continue until interest rates peak, and then after that it'll be back to more normal robustness, especially with the surge in immigration that's going to happen under the Labor government's policies. So, longer term, I'm more positive.
Yeah, I'm not so sure. I think there's a big thing going to happen next year when we've got a lot of people who took out fixed rate mortgages during the COVID period at very attractive rates. They're all going to be rolling over back onto variable loans in the next 6-9 months or so. And there's a few punters are going to have a bit of a shock to their system when they come off a rate that's around 2% onto a rate that's around 5%. So I'll be interested to see what stress that puts on the system. And I think, we've probably got another 12 months of pressure on housing. I'm not so optimistic, but that shows you the range of views on the Chanticleer team there. Tony, you've been following this one. Grant Wilson, who is a economist, investor, analyst, and AFR columnist, he's facing a big moment on Wednesday.
Yeah, Grant stopped writing for the Fin Review to do this campaign, a real activist shareholder campaign, but he really sort of carved out a quite a strong reputation at the start of COVID by coming out with forecasts that basically said this was really going to affect the economy badly. He got it very right. There's a vote on Tuesday of the shareholders of TNG, which owns a lithium mine in WA, and the proxies have to be in by Sunday. The chairman of the company, new chairman Neil Biddle, today put out a restructuring of the board, which I think is a last-ditch effort to win over votes. We'll have to see whether that works. But, it's a fascinating one because I think if Grant wins that, it will be the first major activist takeover of a board by an individual in a very long time.
Yeah, fascinating. We'll watch that closely. And then on Thursday night, Friday morning our time, we've got the really big moment of next week, and that's when the Federal Reserve in the US makes its next decision on interest rates. I think up until the start of this week, everybody expected 0.75% rise. Tony, could we get the big 100 basis points, a 1% rise? Is it possible?
I think it's possible, James, and I think we might even have a similar response to what happened this week. The algorithms, and they're 65 to 70% of all stock market trading, will take over. These are the unemotional, dispassionate, quantitative-driven machines that operate each day and could actually smash the markets.
Yeah, interesting. I reckon it might go the other way, Tony. I reckon if we got a 1% rise, people might say, okay, the Fed is getting racing to get to lift rates and hurt the economy, and that means that the recovery is going to come a little bit sooner, and perhaps there'll be a bit of a rally. We have tended to see markets rally on the day of the Fed and then fall away. So perhaps we could both be right. An initial spurt and then a bit of a fall away as the week continues. But that's one to watch, and it'll be a big week for the Fin Review. We'll have all the coverage right across the website. Now, from next week, we're hoping to take your questions to make our podcast as interactive as possible. So if you've got a thought or an idea or a question for the team here, please email chanticleer@afr.com and hit us up with your question. Well, Tony, thank you so much for our first episode. It's been great fun, and there's a lot to look forward to next week as well.
Thanks, James. Talk to you again soon.
Chanticleer was hosted by me, James Thomson, and Tony Boyd. This podcast was produced and edited by Lap Fan. Technical production was by Cormac Lally. If you like our podcast and you want to hear more, consider rating and reviewing us, as it helps others find us. And follow us on Apple or Spotify or wherever you get your podcasts. At the Financial Review, we investigate the big stories about markets, business and power. You can subscribe to the Financial Review, the daily habit of successful people, at afr.com/subscribe.
The Australian Financial Review.